Hello, YouTube. Today we're going to be talking about the thing that has not happened since 2000. No, it's not the dot-com crash. It is actually the 210 yield inversion. We are not relenting. We put in a massive cup and handle. We have a golden cross, which means the short-term price is over the long-term price, and we're making fresh highs. We're now currently at 1.11. This is going to be a new all-time high. I'm now going to zoom out to the monthly chart to make it a little bit easier to see. We note that we have a weekly golden cross, we have a monthly golden cross, and that happened back in 2018. So the reason why this is so important is because a yield curve inversion is something that generally signals there is something that is wrong in the stock market. And right now, the stock market it seems like it's able to shake off any bad news. When bad news is interpreted as good news, that's something we have to pay attention to. So right now, again, we're looking at this predicted the 2000 crash. It predicted the crash. Predicted the crash in 1989 or Black Friday. It predicted the move in 2000. It predicted the move in roughly 2007 and 2008, and in 2018, and then again now. So there likely is a top being formed, but the saying we all like to use is that the market can remain irrational longer than you can remain solvent. So is this a true predictor of a recession coming up? Did we not already get our true recession? And what does this mean? Because with Nancy Pelosi landing in Taipei today, we're now knowing that there's going to be continued geopolitical tension between at least August 4 and 7, when there's going to be military exercises happening in the area. So if we think about this and we look at the chart here again, the yield curve inversion is screaming a recession. It's really important to note that this could mean it might take up to 12 months for us to actually have our big, nasty cut. And the fact that the market's actually down by about 0.66% today, but the dollar is up by 0.86. So what this means is that if the dollar was flat, the S&P would have actually closed out unchanged today. And that's a really big deal because there was some huge tension happening. I'm now going to have a look at the dollar, which is something else which has been a culprit lately for equity markets. So again, we look here at the weekly chart. We notice that we have a W or a win. We also have that golden cross, which means that DXY and TNX are starting to break higher. Why? Tina, there is no alternative to US assets. So with this golden cross and a bullish pattern and getting right back up here to resistance at 106.56, and again, we talked about the 1989 stock market crash and the yield curve inversion. Well, the dollar's right back there. It's back to a level we've not seen going back to roughly 1989. And then we have our head and then we have our shoulder forming here. So if this is truly a bearish pattern or a head and shoulders, we cannot get back above 106.5. That is likely going to add more pressure to equities or stocks. And we're going to have a really hard time going higher. If we now look at the daily chart here, we can note that we have an uptrend, or the blue line, which is basically going to be our 50-day moving average. We would also note that we've now bounced off our 50 DMA, and we're right back to resistance. So this is going to be really interesting. Are we actually going to break back up? Are we going to break back down? And again, whatever the dollar does, as a rule of thumb, we will have the inverse happen in equities. So if the dollar goes up by 1%, stocks should go down by 1%. And that's something we have to pay attention to here. So again, we have TNX and DXY, which are both giving us some issues here. We also note that VIX is also now back above 20, battling for its 200 weekly moving average right now. And we got these potential demonstrations coming up between the 4th and 7th. So if we now jump forward to our key dates, I think we had 3 Fed speakers today, and we also had Bostic over the weekend. So we heard from Mester, Evans, also heard from Dowley, and we heard from Bostic over the weekend. They're all pretty much singing the same tune, right? Oh, blah, blah, blah. We're not done tightening. Got to go higher, yada, yada. And the market just shrugged it off. The market did not really seem to care at all. So when bad news is good news, why would that be? Well, it would be because the Fed is likely not going to be able to continue to advance. And I don't want to make this video super long, but I've talked about this before, where we know what the Fed put is. It's when we hit the 200 weekly moving average. Well, with bad data now, what it means is that we're going down for a soft landing, right? Jobs are starting to close, but not at a huge level. It's roughly 4% lower than the expectation. So that's positive. And if we look at the the Fed funds rate, the reason why I believe that bad data is being interpreted as good data right now is because again, as we look here to the Fed funds rate, which is basically what the Federal Reserve charges for interest, we have a downtrend here. And we approach the area of breaking something. So again, we hit the downtrend, we reject, hit the downtrend, reject, hit the downtrend, reject, hit the downtrend, reject, and one more time, hit the downtrend, and again, at least rejecting, maybe not rejected. So if we've seen the peak in yields or peak hawkishness, the data should be coming in where bad data is good data, because maybe the Fed can't afford to break anything else. Also really important to note that when there is geopolitical tension, or again, geographic political tension, which just means countries are fighting, that generally is going to mean that you want your country to be strong. You want the equity markets to be strong. Why? Because then people feel good, right? They feel good about their country. They feel good about where they are in the world. So it's important for governments to have the support instead of being like Russia, where they delist everything and just shut the stock market down. Why? Because we're in a free and open society. That's how it works. So if you look at the key dates now, the market's been able to digest the wall of worry for, I don't know, it's been like weeks. If you look here to our fear and greed index, we're almost back to neutral. That's correct. We're actually higher than yesterday. Even with potential, again, WW, you know what? I don't want to say the words. So we ticked higher. People are less scared today than they were yesterday. Why? They're breathing another sigh of relief. Just like when earnings weren't so bad. There's actually a meme that I saw with President G where it's showing that, again, he was the big doge before Nancy came. Then Nancy comes and he's a little baby. So again, as of right now, they're playing chicken. And that's what it seems like why we're moving higher, because not having a confrontation is good. The potential for bad was really high. Came in with a surprise. It's not so bad. So if James Bullard, again, he's the guard dog lately. So if the Fed is trying to get a message out there and 4 or 5 other Fed speakers weren't able to do it, Bullard's going to be out there yapping today. When? At 6:45, he's going to be yapping. He's going to tell us, oh, we got to get higher, got to get a 4%, 5%. Fed's not done, blah, blah, blah. And whatever he says, what I am more focused on is the reaction we're going to get to what he says. If we end up moving lower, I'll be paying attention. If we end up going up, I'll be paying attention. And then after that, we got some data coming out tomorrow, ISM, and then notably payroll Friday and unemployment. This is the big one. This is going to be the most important data number of the week, which is why it's bolded and underlined. Continuing our story here. Part of what we also have to keep in mind is, again, looking here at the futures positioning, because I've had a hard time actually getting this data. Bloomberg gave a screenshot today. I took it and shows that future positioning is near the most bearish level since 2016. So this could be why not having the worst case scenario or new, fresh, bad data means that some shorts are just covering. They're like, man, get out, cover the short. And we went from being roughly long about 0.8 million shares to now down by about roughly 0.2 here. So that's a switch of 1 million shares. And remembering that for the futures, every one contract is actually 50 shares. So what does that mean? Well, it means that on the E-mini futures, which right now is trading at about 40.91, there are roughly, there's been about 50 million shares that have gone short. And at a share price of roughly 4,100, that's 205 million. So, 205,000 million. What is that? Well, it's a lot of money. There's billions that are short right now. And this could be the juice we need to have a short squeeze. Why? Again, one more time, people are continuing to be less fearful. So if they're less fearful, even when we're potentially going to have a huge geopolitical flare-up, which we're already seeing in Europe, it means that people are probably not as scared. Longs are dipping their toes in, myself included. Have I gone full risk on? No. I need more confirmation, but this is a pretty big deal. So unless we get something devastating like 2015 or 16, which I believe was Brexit, it doesn't seem all that bad. We continue to climb the wall of worry. And when we try to think about what is happening today, are we seeing what we expect? Well, let's zoom out to some higher timeframes, because looking at the 1 day doesn't look all that bad. It's mixed. It's a little bit red everywhere. There's no huge pockets of deep red. It's mixed. We look at the weekly heat map. Not all that bad either, right? It's mostly green. Healthcare down a little bit, Visa down. Otherwise, it's pretty green, right? Lots of gains here. Now we look at the last 1 month. Same theme. So there is clearly rotation happening into what? Into big tech, into defensives, into durables. into everything basically. So even though we were getting a screaming warning from the 210s yield inversion being at a new all-time high and continuing to go up, there is still a bid out there. There's still a bid and there's shorts who are stuck. So that's likely what is happening. We're getting a short squeeze. And to summarize this really simply, we can look at one chart here. I believe it's on this one here. It's the S&P on the daily chart. Then we'll have a look at QQQ. And then otherwise, everything else is on the weekend video, which will be left at the end. We can note here that I'm just watching these lows right here, roughly 407. It's not really all that complicated. So as we are still currently within our cup with a handle forming, this is a bullish pattern for me until on a day where we close lower, we also get increasing volume. That did not happen today. Lower volume, lower low, lower high. What does that mean? Sure, we closed lower than we opened, but it's not with conviction. There's no conviction down here. I need to see a fat red bar. I need to see a lower low and a lower high with a fat red bar. And today was the day for the bears to do it. They failed. So if we're going to continue to go sideways, we could test as low as roughly 400 or our gap going back to the start of the big short. And what I just showed you for the short positioning really matters because this is where they started initiating. They're losing money. So are they going to give up? Are they going to double down? I don't know. We got to watch for that. And if we start coiling up into here, the big test really comes on roughly August 12th, which is going to be our apex. Are we going to go down or are we going to go up? So that's simple. QQQ right around the same area, roughly 313. So looking back to the tops right here, again, just looking at the tops we formed here. If this is a bullish back test, QQQ closed higher than it opened. It didn't really close all that red, but down by 0.3. And it's holding the previous top. So as of right now, this is still looking constructive. Is it enough to say we're ready for a fresh leg higher? I don't know. But the video that queues up here in a moment will tell you what I thought on the weekend in terms of where we could go for the week. If you like that, please click it now. Otherwise, thank you for watching. I would appreciate a comment. And otherwise, subscribe to the channel. We put out videos every single weekday. Thank you.